I want to tell you about a couple. I'll call them Robert and Carol. They came to me thinking they had a small question, simple question. They were downsizing from their home currently and they had to pick a mortgage. They just wanted to do a gut check. And it turned out to be one of the most important financial conversations they had before retirement. So, who is Robert and Carol? Robert is 58, Carol's 55, and between them they had built about 1.8 million in assets. That's a solid picture. Robert has a pension, Carol has 401k. Robert is retiring in 2 years and Carol's going to work until she's 65. They're going to sell their current home expecting to net about 380,000 and then buy something smaller for 850. On paper, it's totally manageable. They can completely afford it. But when Robert retires in 2 years, their household income drops by 112,000 overnight. His pension kicks in, that's 4,200 a month, but that doesn't replace what he was earning. So the mortgage payment that looked comfortable today didn't work. So we had to stress test it against what their income actually looks like in 3 years. And when we did that, the 30-year fix they were leaning towards felt a lot tighter than they expected. So we looked at 3 options. The 30-year fixed, which is stable payments and never changes, but they'd be carrying that payment into their 70s on retirement income. The stability cuts both ways. The ARM, which is a lower rate up front, but the adjustment period landed right in the retirement years. That's exactly when you don't want a variable payment. So we took that off the table fast. And then the 15-year fix, it was higher payments now, but the mortgage is gone by the time Robert's 73, and the rate is slightly lower than a 30-year fixed. So over the life of the loan, they'll also be paying less interest. Then we looked at one more lever, their down payment. So instead of putting the 380 down, what if they put 450? Smaller loan payment, better fit for retirement. Now, here's what they did. They did take the 15-year fix, put 450 down, because Robert's pension is guaranteed income. That's the floor. That changed everything. They didn't need to preserve cash the way someone would without a pension. So putting more money down reduced the loan. The 15-year rate saved them money, and they'll be mortgage free well before they need their assets to fully carry them through. Now, that is so important to do prior to retirement if you're looking about changing mortgages. Think of how your life is going to be in retirement when you model those numbers, not how it looks now. Because you want to see how is it going to look like when your income changes, when your pension kicks in, when your 401k kicks in. The mortgage you choose is the final chapter of your career. Isn't just a financial decision. And those two things need to be looked at together, your mortgage and life in retirement.